Oscar Health CEO Mark Bertolini just said that his stock in 2027's fair value should be $45 to $55 per share. In this video, we're going to be going over the exact interview that he just did a month ago, talking about that price target for his stock as he is the CEO, and talking about Oscar Health as a business. You're not going to want to miss this if you're an Oscar shareholder like me, a big bull on Oscar for the long term, or if you're on the fence about getting into Oscar with all the risks out there. So let's get into it. And if you enjoyed this type of content, like, follow, and subscribe below. And if you want to follow me more on X, where I post more daily, give that a like and follow in the description as well. Let's get into this.
Welcome to Branded. I'm chatting with Mark Bertolini, CEO of Oscar Health. In your business, you have one really important customer, and that's the federal government. So as CEO, how you create the conditions to take care of your customer?
I would start by our clientele are people who otherwise couldn't afford health insurance. So these are people that were largely uninsured. And in the United States, we had 42 million people back in 2010 that didn't have insurance coverage. And that was close to 12% of the US population. Today, we have less than 7% of the US population because the Affordable Care Act, passed by the Obama administration, now has 24.2 million people in one risk pool. It's now the largest insurance risk pool in the United States. And so we are able to provide low-cost coverage through both a larger risk pool where you can spread risk and get lower costs, and the government subsidized people who are at certain levels of the federal poverty level. That brings more people in. And the most recent enrollment increased the overall pool to 24.2 million people. So those are the people we take care of. We do it uniquely in that we are the first platform, end-to-end health insurance platform that has been built since 1972. Everybody else uses the old one. It's called Health Edge, in their own version of it. And we are a cloud native, digitally oriented firm. So we have a lot of digital connections to all of our members. We're easier to do business with. Our brokers that sell the product, they are digitally connected. Our providers are digitally connected. We use extensively large language models and artificial intelligence to run the business more efficiently. And since I arrived in April, we have taken 1,400 basis points out of the operating infrastructure of the firm by deploying large language models. Why do we do that? How can we do that? Well, again, we're a single throughput platform, cloud native. But secondly, we have one version of the truth in our data set. And as you may well know, AI entirely relates to the data you use.
I got to pause right there. So what he just said there was massive. Not just the fact that they took 1,400 basis points off of the SG&A, right? But also the fact that they are the first company built from the ground up to be using like an Amazon Web Services built on Python, and basically being a tech-driven, tech-first company in the healthcare insurance sector. That is so massive. Now, the big argument is, if your only argument for Oscar is that they use AI, well, then United Health and Aetna and all these other healthcare insurance, they use AI as well. Okay, yeah, they may use AI as well, right? But they weren't built from the ground up on this, right? They weren't built from the ground up on this, and they weren't attacking this market as a tech-driven first mindset, right? They're using outdated programs, outdated websites, right? It would take a lot of money for them to upgrade everything. And Oscar's over here doing this from the very beginning, bringing down costs, having great medical loss ratios, the best in the sector, right? So I just wanted to highlight that point real quick.
Using to drive the insights. And so with one version of the truth, less bias as a result, we are able to produce more results with large language models and AI. All of that gives us an NPS, a Net Promoter Score of 66.
Great score.
In an industry with an average of 0, which gives us an advantage of growing. So we've been growing very fast. We have grown
An NPS score, I think he said 60 some. Yeah, 60 some, right? And the average is 0. Massive, guys, massive. Basically meaning the reviews, what people are reviewing. We already know that healthcare insurance and healthcare is very much a hated sector by a lot of people. The waits are long, they deny claims, it's annoying, it's a pain in the butt, right? And to have a favorable a favorable reviews by your users, where so many, like United Health, right? Like people were like their CEO was, right. I'm not gonna say it because we're on YouTube. He was, they made him go away, right? And people online were cheering about it, of somebody else's demise, and that's sad. Obviously, that's horrible. But that's how hated it is, guys. That's how hated it is. And Oscar's over here with like getting positive reviews.
By over 1 million members since I joined. We have higher retention because people were easier to do business with. People like what we do. And we also offer products which are counterintuitive to the insurance industry. And we offer products to diabetics. We encourage diabetics to join us. People with chronic obstructive pulmonary disease, people with asthma, because we know how to get them engaged in the healthcare system quicker and more digitally, which allows them to get better quicker.
How do you sort of reconcile? I mean, you have a startup originally, and a prominent startup that was well known, that was in many ways, when you and I have chatted before, you said like the goal was to almost not have people with a lot of health insurance experience, because we value innovation, we value disruption, we want to do things differently. Our whole reason for being in existence is doing things differently.
Is because the health insurance sector has not been disrupted whatsoever, and they are going after this disruption. They aren't hiring people in the healthcare sector like he just said. They're going after tech-driven, AI-driven, younger youth, right, to help run this company, to make it lean, mean, and powerful, like a Robin Hood or a SoFi, going after the younger generations. And not just that, but what I wanted to say about before, this man, Mark Bertolini, he cares. He cares about people. I know that's hard to wrap your head around in 2025, in this world that we live in. But this man cares about people. He cares about people getting the treatment that they need. He cares about it. He's been in this industry a long time. This man almost died in a skiing accident. And this man's I think his child had cancer. And he helped his kid through through cancer. This man is so intertwined in the healthcare industry, guys. Like he was high echelon in Aetna. He was high echelon in other healthcare businesses, and not just that, but he actually worked for one of the biggest hedge funds in the entire world, right? So the man is intertwined not just with the healthcare sector, but also intertwined, right? Also intertwined with the hedge funds, and understanding business, understanding how the stock market works. And people were sitting here and wanting and doubting them. Yes, some ACA subsidies have been cut with the big beautiful bill that Trump passed, and the House passed, right? Yes, there's going to probably be some short-term headwinds in 2026, but this company is so undervalued, its price is that they're losing all their ACA, Affordable Care Act. They're losing all their Affordable Care Act clients, everything. And that's if we don't get an extension in past 2025, which I still believe that we probably will, as most 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 congressional members, are going to get attacked pretty hard, if they don't get something passed here. If they don't do something, the voters are going to speak up at the midterm elections, and a lot of Republicans are probably going to lose a lot of seats. So I think that we still get an ACA extension. ACA subsidies extension. And either way, they already have a plan and they've already guided for 2026 and 2027 for ACA subsidies going away and for a lot of these cuts that we're seeing, right? There may still be some headwinds, but people aren't taking this man at face value. And I see no reason to not take this man at face value. He was retired. He came out of retirement because he believes in this company and he believes what they're doing to help disrupt the healthcare insurance sector and to help people. He came out of retirement, guys, to do this. So.
But they bring you on, and I think you came on board, and was it 2021?
No, April of 23.
Oh, April of 20. Okay, April of 23 to bring some experience, and you're the former CEO of Aetna, and so they're doing the opposite. So how did you kind of come on board? What was that like? Was it culture shock on both sides, where we believe in disruption, and you believe in no, this is how you run an health insurance company? How did that play out? What was your first weeks like?
So 6 years ago, they asked me to come on the board, and the reason they asked me to come on the board is that I had done a speech in 2014 to a large group of people on transformative healthcare. How do we change healthcare in the future? That they played in this company to say, this is exactly what we want to do, what this guy's saying. And so when I retired, they said, could you come on board and join our board? And I hate boards of directors. It's death by PowerPoint. It's stifling. I'm only on 2 boards now. OSCR and Verizon Communications are the only 2 I have left. I got rid of most of my other board appointments. A, because I needed to be here, but B, I just found it to be stultifying to have to work on boards and do all these PowerPoints over and over and over again for hours and have people talk at you. So as a result, I said no to their board proposal. They said, well, would you meet with us every once in a while? I said, sure. So we would meet every once in a while and have a dinner and a drink, and we talk about where do we think this is going? How do we think about this? And when the stock got close to $2.50 from 39, they said, could we meet with you for an hour every week?
Okay, we need to get $37 back in that price. Okay, sure.
So
I would have loved to be a shareholder at $2. Oh my gosh, man! Because this thing ran to 22 recently, so 10x. Insane.
That's actually how they structure my comp. Get the stock back to that price, and you're a winner. And so, so the idea was, and they gave me some shares of the company, and we met an hour a week, and we did a deep dive. And as much as the CEO Mario and the largest shareholder Josh could talk about, we talked about the business, and I gave them some insights. Like one was the CVS contract. I said, when's the last time you negotiated that? And they said, well, we've got another year left on our 5-year contract. I said, oh my God, no, you got to do this every month. You go and talk to them about their discounts. There's money every month you can get from them. And so they started doing that.
Which, of course, you were a director of CVS before, after they acquired Aetna. So this is good advice. Yes.
And I used to negotiate with CVS before they bought Aetna because, I used to negotiate the contract. So when I first started with the firm, Brian Williams used to say to me, I need more earnings this quarter. And I used to go talk to CVS about the maximum allowable cost list and get discounts and find anywhere from $30 to $50 million every quarter. So it was like, that's the sort of thing you do. And then we talked about how the provider relationships work, how the contracts work. We just started taking apart the business. So while I was talking to them about how to think about it, I was learning about them and the firm and how they thought about it. Because I said to them, and at that time, I was working at Bridgewater with Ray Dalio. I was helping him move on. And I was chairman first, and then I was co-chief executive officer when the CEO left to run for Senate for reasons I'll never understand.
This man's pedigree is like bar none. The man worked at Bridgewater, was a co-CEO at Bridgewater with a Ray Dalio, one of the most talked about investors of all time, right? And he was the CEO of Aetna, like I'd said before. Like the man's pedigree for being a small guy, $14 stock, $3 billion in some market cap right now as of Friday's close. To have the knowledge of hedge, like the stock market, and to have the knowledge in healthcare and health insurance. Yeah, this is the kind of guy that you want to bet on big, like I am with this company. And just at face value, we'll get into it later. We'll get into the high five snapshot, looking at what I believe is the fair value based on discounted cash flow model, based on EPS model, based on PE, based on prices, based on a lot of different metrics. They all scream low risk, high reward. This is the man I'm betting on.
And so, I was just finishing bringing the new CEO along. I worked with Nir Bardea for a year and a half, and I was going to go back on the board. They said, "Hey, could you come and run the company?" And by that time, I knew enough about the company. I knew enough about them. I had the feeling, because when they redid the CVS contract, that was a massive amount of money. But also, when I talked to them about fraud, waste, and abuse, which can be anywhere from 5 to 7% in the state of Florida alone, which is where almost half of our business is, and they were only getting 1%, they said, "You guys got to do a better job on this stuff." They said, "Well, we're trying to be innovative. We want more." I said, "If you can't make money to reinvest in the business, to grow it, to reinvest in our member experience, we're not going to last long." So they asked me to come on board. They offered me founder shares to fix it. And they all accrued to me when with some vesting, accrued to me at certain price points. And I put those price points $1 more than the employee's option exercise price.
So that the employees would be able to benefit as you're benefiting as is going.
The employees won first. Yep. And then I would get paid. Because I mean, this is not about the
Stand-up
money for
guy.
me anymore. I'll be 69 in June, so it's not like I need to put more money in the bank to keep the lights on at the house, or put food in the refrigerator, or feed my dog. I just this was sort of um, a a passion for me, in a way that the CVS deal didn't work the way I thought it could work. I wasn't there to make it work. So, I don't know exactly why it did. I have my assumptions. But when the last moment came along, and I was convinced Mario was okay with it, because I was going to be taking his seat, I asked the question, "Why are you guys in this? Why do you want to fix it? Is it just to flip it? Because if it's just to flip it, I don't want to waste my time. If it's to change the industry and really take this platform to where we think we can go, I'm your guy. And I'll build a team."
If it's to change the industry, I'm your guy. First, the employees get paid first on the shares going higher. Then I'll take my cut. I'm 69. I don't need to do this. Second, if you're just trying to spin up this business and then sell it to UNH, United Healthcare, or Concordia, or whoever, I don't want to do this. Why would I waste my time? I have a passion for this. That's why I came out of retirement. If you're looking to change the industry, a 3-point-some billion dollar market cap, if you're looking to change the industry, United Health Group is a $300 billion market cap, a $3 billion market cap for Oscar Health. If you're looking to change the industry, that's the last time I'll say it. I'm your guy. I'm Mark Bertolini, and I'll be the CEO. I'll be the captain of Oscar Health. Love it.
And we'll create succession, and we'll make this company the kind of company that could put all the others to shame. And that's why I joined.
In this type of industry, I mean, are you an operations expert and you go by critical function? I mean, the same way that, Tim Cook at
Put them all to shame. Put them all to shame.
Apple came from operations. He knows the inner workings of his business well. Is that your
Some good coffee.
sort of special sauce, your expertise? Is it operations and health insurance?
I know how to do operations. I know how to do it really well. I get bored by it. So my secret powers are fixing broken things and building new things. I hate making trains run on time. I can find people who can do it, but I hate making trains run on time. And because it's boring to me, I want to fix it. I want to make it better. I want to drive a Zamboni machine on the ice. I played hockey, a goalie all the way through college. I want to drive a Zamboni machine on the ice because that can't be the only pattern that works. But it's not about the pattern for the Zamboni machine. It's about the hockey game. And so you don't want me running a Zamboni machine. So I come in and I figure out what's wrong. I put together the plans to figure out how to grow them. And the very first thing we did, as soon as we had that all put in place, the first pillar of our strategy was run a great insurance company. The second pillar was create the best member experience in the industry so people want to come to us. Instead of us having to sell them, they want to buy us. They want to buy what we have. The third was extend our lines of business, which is what we're in the process of doing, so that we could help more people in the individual market. And the fourth was extend our platform to others in the industry so they can take advantage of the capabilities we've created.
What do you do?
Bang. Like, come on, guys. Are you not seeing it? Are you not getting excited? I love this game. I love individual stock picking. And I feel that we have found an absolute gem in Oscar Health, guys. An absolute gem. This man that is the captain of this ship that is Oscar Health knows his shit. He knows it. He knows about the stock market. He knows about the healthcare industry. The man was a CEO of Aetna, a major health insurance company. He was a co-CEO of a major, massive hedge fund. He knows the stock market. He knows the healthcare industry. They are looking to basically do what Robinhood has done, disrupting the brokerage industry, making a platform, making customers come to them, and loving the UI, loving the app, loving the experience. What SoFi's doing, what Palantir's doing with the government and with commercial sector. Going at what HIMSS is doing in the pharmaceutical sector, making people love the product, the app, and making the integration seamless. Oscar Plus will only grow from here, and it will continue to expand into other markets. This isn't a 1-year play. This isn't a 2-year play. This is a 5 to 10-year play. They're a $3 billion market cap, currently massively undervalued, disrespected. I think in the next 5 to 10 years, they have a real opportunity to disrupt the health insurance industry with this man at the helm, Mark Bertolini, and minimum get to a $10 billion market cap, if not 20, 30, 100 billion. I told you United Health has a $300 billion market cap right now. That's after the massive plummeting that they've done from over 600. They were at half a trillion. Guys, they were at over half a trillion market cap. We're talking about $3 billion market cap here. I think it could be massive. I think what I have invested in Oscar today, which isn't my final number, the more we drop, the more I'm buying, baby. The more I'm buying. I think the amount that I have invested in Oscar today, which isn't the final amount, I'm going to keep buying, is going to become millions of dollars. Let's get back to the video.
To when you come on board to accomplish two things. One, make sure that your ladder is up against the right wall. And so that maybe looking at things from the outside isn't the same as being on the inside. And two, what do you do to make sure that there is buy-in from everyone else for these kind of changes? Because just you could come in here and like Mark says this, Mark says that, and the team say, hey, we've been here longer than he doesn't understand what's going on. No, this is the way we do it. How do you get through all of that for creating change?
We're disruptors. What do we need that 68-year-old guy here for? In my first company, we ran out of money in 3 years. They brought in a guy that was the chairman of the company we had bought, one of the companies we had bought, growing it, and he was 62 years old. His name was Cal Lippett, great guy. He comes walking through the halls as acting CEO for a while. I was the head of sales and marketing. And as he walked through the hall, everybody's going, what the hell's Cal Lippett doing here? He doesn't know anything about what he's going. What the hell's Cal Lippett doing here? He doesn't know anything about where we're headed. He's not disruptive. He's going to do everything like he did before. And when I walked into Bridgewater and when I walked in here, it was like, I know I'm Cal Lippett. Oh my God, I'm Cal Lippett. So, but it's not only putting the ladder against the wall. You got to know where people are. If you can create change, having the answer and saying this is the answer, go do it, isn't going to work. What you have to do is sit with them, hear what they have to say. How do they think about it? You ask more questions. Well, did you think about this? Did you think about that? Because most people underperform for 3 reasons. One, they're a sociopath and they mean harm. We can spot those people. We're pretty good at that. Number 2 is they don't know how to do it. And number 3 is they're not suited to do it. And until you can figure out those last 2, you don't have any business jumping to what the answer is until you hear it. And that's why I did 10 weeks of deep dives across the organization, met everybody, heard where they were coming from, topped the list of all the things that could be fixed. That's okay. Now, how do we go about making this group do it? Because people coming from large organizations like me have a tendency to look for their people. They had people. I always had people. I had people around me all the time. If I thought of something, a whole organization would spring up to go look at it. At Aetna, in this company, you got to do your own work. So bringing in people that had people before often fail. You have to take a totally different view, and you have to get down at the ground level again, and you have to do the work. And that's why I was doing it for 10 weeks.
Well, and do you feel like, I mean, it's a different definition of CEO that has emerged recently that I think, usually the normal definition of sort of CEO is like you kind of like you sort of point the organization. It's like the direction we need to head. You do it, and then lots of other people move in that direction. But you've got your singular job is to make sure that we're pointed in the right direction, or that we need to shift that. I mean, that's one definition. I sort of hear now by just to finish, and I'd love your thoughts. Elon, because of Elon Musk's style, and he's become obviously very prominent, he sort of has this alternate thing, which he's like the chief problem fixer in his companies, where he's like, he has a lot of companies. So each day a week is one company. What's the biggest problem you face this week? I'm going to solve it in this day. And he's like, a lot sort of sits with him to be this sort of fixer, as opposed to, I'm sure he has people too, but it's emanating from that. So is that a new model that is sort of unusual because no one thought that was scalable before? What is the job of the CEO?
You see, so the first person you described was George Washington standing on the bow of the boat crossing the Delaware River, right?
Okay, like in the painting, right? You're saying, okay, yes.
I divide the world into 2 kinds. There are 2 kinds of CEOs. There's a Platonist and there's an Aristotelian. And the Platonist, having thought the great idea and communicated it, considers their work done. And the Aristotelian translates Plato for the masses so they can get the work done. And so I like Aristotelians. I like people who not only can see what needs to happen, but also is willing to get in and do the work to make it happen. Because that's where strategies become successful. This idea of applied science, commercialization, and scaling is where most organizations fail. And so unless you can sit there and say, okay, here's what I'm thinking, how can we imagine getting there? And what are the steps to get there? And have that conversation and then sit with the people and monitor its results and shift as you go. All the greatest companies, most of them never, what they started with was not what they ultimately became very successful for. Like the original Macs. Now it's iPads and iPhones and all these other sorts of things. So somebody had to see the vision. And Steve Jobs' vision was, I want an anthropomorphic relationship between the human and the device to be so amazing, everybody has to have one. And he did that with Johnny Ivy in the beginning with the Mac, the big Macs, the original Macs, the color Macs. Open it up, found the transistors just sort of glued to the shell. He goes, why is this like this? Said, nobody's going to see it. He goes, I see it. Line them up in this order, all of them. When he did his store in New York, the marble floor, 80% waste. George Blankenship, who I've worked with, who was this guy that built the Apple stores, brought 2 pieces of marble in. He goes, which one do you like, Steve? He goes, which one did I pick? He goes, no, no, which one do you like? He goes, which one did I pick? And finally he goes, George, can you come outside with me for a minute? I want the one I picked. He goes, but that's got 80% waste. This other one's got 20% waste. You can't tell the difference. He said, buy the F and quarry if you have to. I want that marble. So you have to have this view. You have to have this view forward that you stick to and hold to, but you have to bring people along. Otherwise, it won't happen. So Aristotelians more than nature. And that's
I love that. I love that you like basically he's saying you have to have that conviction. And this applies so great to investing. You have to have that conviction. I was buying Oscar down at 11 all the way up to $22 per share because I honestly am looking out into the future, next 3, 5, 10 years for this company and the massive upside for this company versus the small amount of risk right now for this company based on the fundamentals. It's already massively undervalued. It's already massively discounted. And so the conviction comes not when we're at $22 or $18 per share when I was buying at 11 and 14 and 16, but it comes whenever now we're down to $14 in some sense and we've literally crashed about 20 or 30% in a matter of 2 weeks. Right? That's when the conviction really comes. And if we continue lower down to 13, 12, 10, 11, right? That's where the conviction continues. Are you going to double down on this investment? Or are you going to sell and move on to something else and maybe try to time lower? A lot of people are telling me, "Oh, I got out and I'll get back in at 10." What if 10 never comes? And then what if we go to 20, 30, 40, 50, 100, $200 per share? You missed out. You missed out, or you're buying back higher. Trying to time the market is impossible. Trying to time stocks at their bottom is impossible. I bought Meta back in 2023 at about $100 and some dollars, I think was my lowest buy. It got down to $88. Did I buy the bottom? No. Did I make massive amounts of money on Meta? Did I 7x those shares that I bought at 100 and some? Yes, I did. Come on, guys. Come on. Be an investor. Dollar cost average. Think years, not months or weeks. You want to be a trader? Awesome. I do that in my community. You want to be part of that community? Where we teach you how to invest, we teach you how to trade. We have indicators, we have strategies for investing and trading, we have courses, we have all of it. You want to be a part of that community? The link's down in the bio. Come join the High Five community. Over 150 members right now of like-minded people looking to be better investors, looking to be better traders. We do it all. Also, if you're enjoying this video, guys, leave a like, leave a comment. Tell me what you like most about this interview. Tell me if you're an Oscar shareholder, or if not yet, you want to buy lower, or you have a certain price target you want to start dollar cost averaging at. Let me know in the comments, guys, and subscribe if you're not already. I do content like this. I don't just talk about Oscar. I talk about a lot of other companies as well. We talk a lot about a lot of other high five gems, which are companies like Oscar, Hood, Palantir, SoFi, that follow those high upside plays.
what Elon Musk is. He gets in there and he does the work. And I do too.
You've mentioned to me before, you're 10 weeks in, you sort of listen for 10 weeks, but people get a little bit antsy. And you had a certain conversation. You have some prominent investors and founders in Oscar Health. Josh Kushner is one of them.
Josh Kushner has direct ties to the Trump administration. Family ties. That's another bullish thing. It's not like end all be all, like, oh my gosh, Trump's gonna do whatever they say. It's not like that, but they do have connections, which is always better to have connections than no connections.
people get antsy when like you're supposed to like fix what's broken here. What do you when do you know to listen and when do you know it's time to get to work when you're having those kind of conversations and investors are knocking on your door saying, hey, what's going on here?
A guy coming in from a health insurance company, which they don't like anyway, and older, who's, beyond his retirement years and has made all his money. Why do I want to listen to him? What does he know? So it's in the conversation you have and in the deep dives when you're asking the questions and you see the light bulbs going on. So if it's a person who doesn't understand and you teach them something, they come back having done the work. If it's a person who's not suited to do it because they don't like working that way, they're in the wrong job. And you have to start sorting people out like that. And that's what that 10 weeks was about.
I see. So you're actually not just asking questions to get answers or perspectives, but you're trying to do this sorting process to understand who you have on the basis of that.
And how do I get it done? Because I can't do it all myself.
So this was 2023. We're at the beginning of 2025 now. Where is the business now on this journey to go? The stock price is higher. I think I saw it around 16. It probably fluctuates, but $16 a share. You got a market cap of about $4 billion. How far along are you on your journey now?
We're through in 2025. Our objective is to have so we made money in 24 for the first time. We made adjusted EBITDA in 23, which is what we told the street. But in 24, we actually made EBIT. We made real money you can count, right? Instead of funny money. And so that kicked it off. This next year, we've promised 2.5% margins to the street in our earnings through the year, and growth of up to 11 billion in premium. And why those two numbers matter is that 11 billion at 2.5% margins in the insurance industry generates a $5.5 billion market cap. We're at 4 point something right now, 4 point low, right? So that's one piece. At 5% margins, you get a 1x of revenue. And so by 27, what we committed to the street is we're going to have 5% margins, real margins, not EBITDA, EBIT, and we're going to have 14 billion in revenue. That makes the stock price of the company somewhere between $45 and $55 a share, depending on.
What's the stock price today? What's the stock price today? $14.38. $14.38. And the CEO, Mark Bertolini, which I've already talked to you about his character. I've already talked to you about what kind of man this is. That he came out of retirement to come help run this company. Not to flip it and sell it, but for the right reasons. To disrupt the healthcare industry in a positive way to help people get the insurance and healthcare that they need and want. People hate this healthcare insurance sector. They hate it. And so we're sitting here, and the man just said that they're targeting. This is June. This is June 2nd. This video came out. June 2nd of this year. So last month, this video came out. Right? We already knew about the big beautiful bill. What was going into the big beautiful bill? We already knew ACA subsidies were getting cut and not renewed so far for the end of this year. And this man still said and guided for 2027, $14 billion in revenue. $14 billion in revenue. Well, if we look right here to the High Five Snapshot, this is my personal valuation tool. If you want access to this, this is in the High Five investing tier. Links in the description again. If you want access to this, if you want access to over 100 High Five snapshots on all different companies, Zeta, Meta, Google, Palantir, NVIDIA, whatever. You name it, I got it. You want it, I got it. I can make it. And you get access to actually building your own and running your own projections. But let's look at here, right? He said a 5% margin rate. Now, let me tell you this, right? This free cash flow margin rate, they're already doing 10 to 15% free cash flow margin rate right now. I have in here for this next 1 to 5 years, 5%. That 5% margin rate that he's talking about He's talking about a margin rate of essentially on profit margin. So out of that revenue, they're pulling 5% profit margin, right? So that's going to the bottom line. That's going to the earnings per share, right? And that's going to the PE, price to earnings ratio, right? So with that, we're not talking about 5 to 10%. We're talking about 5% on the EPS side, right? On the profit margins. And right now they're doing 10 to 15% on the free cash flow margin side. And I still beat it up down to 5 and 10%, right? 2027, he said 14 billion in revenue. Right here, I have 12.73 billion. Okay, 2026, I have a negative 2%. They're jumping 22% this year on revenue up to 11.20 is forecasted. I think they're going to beat that. And then next year, I have a negative 2% growth number, right? And that still puts them at a $60 fair value today. Now, let's just say next year is horrible. Let's just say they lose 15% of their revenue. They lose 15% of their revenue. But yet, Mark Bertolini still guided for $14 billion in 2027. So that would have to jump us up to, just a massive year, right? So 40%, let's say 45%, almost there. That's good enough. 47%, right? So that would be a negative 15% year, something really bad. But we could just get rid of all that, right? And we could just sit here and say, whatever. We'll just do negative 2%, and then we'll jump to 25% growth, 28% growth. Yeah, that works. 28. We're gonna do 28% growth. 28% growth, right? We get to Mark Bertolini's guidance, basically, of 14.05 billion that they're gonna do in 2027, and that brings us to a $65 fair value on a discounted cash flow model, right? On a discounted cash flow model. He was talking about 14 billion in 2027 puts them at a $45 to $55 fair value based on a price to earnings ratio, which their current price to earnings ratio is 144. Yes, I understand. But that's because they're about to have a 68-cent year, where last year they had a 10-cent year. So their current PE is based off a 10-cent year. Their 2025 PE is going to be 21, as long as they come in with a 68-cent year for 2025. And this man's saying 5% margin, which right now they're at like about 1 to 2% margin rate, right? We're talking about 5% margin rate on 14 billion in 2027. That's going to take their PE. If we assign a 20 PE again, which this company could be growing in the teens, the mid to high teens, or 20% plus for the next 10 years. That PE would be about a 25 to 30 PE. I would assign it, if not more than 30, especially if they continuously grow over 20%, then you're looking at 30 plus PE over the next couple of years. Yeah, guys, it's just crazy. I mean, yeah, so you'd be looking at a $45 to $55 share price. And like I said, if he was going to say 14 billion in 2027, if we come down here, your EPS is going to grow massively, right? Your EPS is going to grow to about in that time you're probably looking at, let's just see, let's do 100% growth. We'd be sitting at $2.37 of EPS. At a 20 PE would be about $47. If we were at a 30 PE, that's $71. So not that much. Sorry guys, I'm just cramming the numbers here. 65% at a 30 PE, yeah, you're at 58. So if you assign it at 25 PE at their current EPS growth rate, which is what analysts have, actually a little bit lower than what analysts have, you get to $1.96 EPS growth. In EPS, you get to $1.96. And then for a 25 PE, you're looking at $49 to $59 based on the PE of 20 to 25. Even at a 20, you're at 45. Again, much higher than $14 per share, guys. Much higher than $14 per share. And this is what he just said. Basically, this is like the base case. This is the base case. And if you want to look over here at Seeking Alpha, not some guy that's just talking to you on YouTube or X, wherever you're watching this. Okay, look at Seeking Alpha. Seeking Alpha has a B plus grade, an A plus grade for growth, profitability of B, and then the momentum and revisions. Well, those are probably, the momentum's definitely down, probably to an F or D now. I haven't got the new one on there yet. Yeah, guys, you start running these numbers, it's insane. It's insane getting to a 14 billion right there. You're looking at almost 27% annual CAGR rate. The SP 500, the market gives you 8 to 9% on average per year. You would get 27% with this company. Should you go all in this company? Probably not. There is risk with it. I'm very confident of putting a big stake of my Roth IRA into it because I have a smaller Roth IRA since I started it, 6-7 years back, and I can't even really add into it anymore without doing the backdoor thing. But yeah, I'm okay with that. But no, I'm not going 100% in this company overall. I have a lot of other investments that I really like as well. On an EPS annual CAGR basis, you're getting 19%. And that's with a 25, 20, and then a 15 PE, which I think you could easily do 20 down the line, right? I think you can easily do 20 running down the line here. And then you're looking at 22%. So this company would be anywhere from 108 to 153 in 10 years' time, right? And I'm sitting here doing a 15 PE. I mean, this is what I'm saying, guys. On an EPS, if you just want to base it off EPS, we're looking at $20.46 this year, and it's currently at 14. So you're getting a massive discount for this year's EPS. You go to next year's, right? 2026, $30 is fair value basically. It's at 14, so you have a double up there. You could see some headwinds in 2026, but then, like he said, like they're going to get to 14 billion in 2027. I take this man at his word because of his pedigree, because of the jobs that he's done before, not just jobs, but as a CEO and co-CEO of a Bridgewater with Ray Dalio, as a CEO of Aetna, a multi-billion-dollar health insurance company, now coming to Oscar. I almost said OppFi. Coming to Oscar for the right reasons to disrupt and eat these other dinosaur companies that launch. There's risks. There's things that are out of their control with the government and bills that pass. But don't you think a man out of Bridgewater and that has been a CEO, big time CEO of Aetna, a major health insurance company, don't you think that he understands that you under promise and over deliver? Why would he say 14 billion just on June 2nd when the big beautiful bill is already being constructed and he already knew what was in it? If ACA subsidies, he already knew those were going away. Why would he say 14 billion in 2027 to be made to look like a liar? To be made to look like an idiot? I don't think you're an idiot if you become co-CEO next to Ray Dalio for Bridgewater, largest hedge fund in the world. I don't think you're an idiot if you somehow become the CEO of Aetna. I don't think you're an idiot if you're on the board of Verizon, one of the biggest communications companies in the world. So all the bears out there that want to poke fun and talk their shit, now that the stock has gone from 22 down to 14, move along. Move along. And come see me in a couple years. Because I promise you, I'll make you eat your words. Nothing's 100%. I'll never say this is 100%. I don't know it's 100%. But the due diligence I've done, the research I've done, and the conviction I have in this company is bar none, if you haven't noticed. And I'm telling you now, when I'm right, I'm going to talk my shit right back. I'm done. I'm a man of God here. Sorry, guys. Them bears, them trolls, they really be pushing sometimes. People got people behind their keyboard. They really got to say some messed up stuff, man. It's not okay. You know, the shit that I'll talk isn't gonna be anything crazy. Okay, I'm not gonna disrespect anybody. Slightly just do a little meme or a GIF or something like, look, send them a snapshot. My shares at $14, at $11, even 20. I'll send them the picture of the shares at $22 and how much those are up. Well, you bought at the high. Oh my gosh, you're an idiot. You're the R word, which I don't like using because that's messed up. All children of God. All children of God. All right. Yeah. PE, it's undervalued. PEG ratio, it's a 0.25. That's way lower than a 1 ratio. And the price to sales actually is wrong. So we'll just put that as a 0. Free cash flow yields, massively undervalued. The only thing I'll say about this, $1 billion in free cash flow. The way their free cash flow works, it's not 1 billion. I would probably say it's probably like 400 million to 600 million after you take out the deductibles, after you take out the way it basically works is they report their free cash flow and then later take out of it. It's really weird with health insurance how it works, but basically just brass tacks. It's not a billion right now. It's more so like 400 to 600 million. But again, if you look at it, the free cash flow margin that I have here, we'll just say $500 million. The free cash flow margin rate that I have here, they're currently doing like 11 to 15%, and I have it as a 5% for the next 5 years. That's saying they don't grow more, or that's saying they go from 11 to 15% down to 5% over this first 5 years of this 10-year analysis, and then they don't even get back to the 11 to 15% they're doing now. They only get back to 10%. So you see, like, I'm beating this up. I'm not sitting here putting in rosy assumptions and getting to 78% margin of safety. I'm sitting here beating this thing up and still getting to a margin of safety of 78% in massive annual CAGR on EPS and DCF. It's a buy on every single projection, on every single price of sales, on PEG, on EPS, on free cash flow, discounted free cash flow yield. That's a buy left, right, and center. The risk to reward ratio on this thing is just insane. It's insane. 1.2 billion in cash. Okay, people want to sit there and say, "Oh, 1.2 billion in cash." Well, they have to use that cash. They have to have lots of cash because when claims come in and they got to pay those claims and they got to pay for people's medical insurance. I understand that. I understand how health insurance works. They bill you every month and they got to raise up that cash. And whenever something happens and you need a claim, you get in a car accident, right? And you need to pay your deductible and then get your car fixed and paid, right? Same thing with health insurance, right? When you break, you need to cash in on that monthly bill that you've been paying and say, "Hey, I need you to help cover this." You pay your deductible and you get the health insurance. MRIs are really expensive. Tens of thousands of dollars for an MRI. I understand that. I'm not a freaking idiot. Okay? I understand that. I understand all the things that all the bears want to say about this company. I understand. Okay? Still $1.2 billion in cash is plenty with how much free cash flow they're bringing in, and it's quite sustainable. And again, I trust the man at the helm. The man worked at a hedge fund. Hedge funds know risk management more than anybody in the world because they have billions and trillions of dollars that they have under assets under management that they have to constantly be risk adverse and risk adjusted for in case crap hits the fan. He was the co-CEO. You think he doesn't know risk management? You think he's not prepared for this? Come on, use your head. Use your head. My goodness. My goodness. Okay. That's the high five snapshot, guys. It's undervalued. I'm buying more. Let's get back to our video, huh?
On the PE multiple from where we are today.
You've talked about, what you've shared with the street as a public company. You have to do this, of course. But would you run it any differently if this was a privately held company? Would it be the same, or what's the difference?
When you're running a public company, you have to show a progression. You have to show growth and the right metrics that lead to the ultimate number. In a privately held company, you may hold back on the not the earnings part, but on some of the other things, so you can make the right investments to get there quicker. So sometimes taking it private, which some companies do, is a way to really sort of get things accelerated internally so that you come out with a stronger set of numbers or the same set of numbers earlier.
You're saying, if I'm going to paraphrase here, but correct me if I'm wrong, but like a lot of what public markets do is they value trust. And trust is based on you say what you're going to do and then you do it. So they don't want to be surprised by, we got this great opportunity and we're just jumping in head first. Whoa, you didn't tell me about that last quarterly call. Where'd this come from? How come I'm surprised? I don't like that. So you're saying that creates a different dynamic.
When I took over as CEO at Aetna, we were at $29.85 a share. When I left Aetna, we were $208 a share. Of that 652% total shareholder return, only 1/3 of it was EPS. 2/3 of it was the price earnings multiple, which is the street's belief in the credibility of management to consistently deliver revenue and a profit that people want in the way of a product going forward. That's what that PE is.
So you're saying, trust is actually measured. Trust is measured in the price to earnings ratio that you experience. And if you're trusted, you're going to be more valuable relative to your earnings.
And in all those quarters, I underpromised and over-delivered every time and never committed more than 7% earnings growth.
Bam! I underpromised and over-delivered multiple times. Multiple times. I forgot about that part. Isn't it so funny that we were just talking about that and how important that is? Oh, this guy must be an idiot. He must be an idiot. What does he know? What does he know? Come on. Come on. My goodness.
Any given year and delivered 17 consistently every year.
Overlooked skill in all of that is not just doing what you need to do to be successful, but also saying what you're going to do in a way that builds trust. And you're talking about doing that gradually. Like just being great results is great, but saying that you're going to deliver great results and then delivering is a huge trust builder.
In my first 2 months at Aetna as CEO, the first meeting I walked into was a whole bunch of hedge funds in the room. I stood at the head of the table. I said, either you people think I'm either lying or I'm stupid. Neither of which endears me to you. See ya. I'm not talking to you again. And I walked out of the room. You get the shareholders you deserve. And then 3 weeks later, I'm meeting with our top investors, and our largest investor, 34 million shares in Aetna, said to me, you need to double your dividend or double your stock buybacks. I said, actually, I'm cutting my stock buyback in half, and I'm not going to increase the dividend. They said, well, what if your largest investor insists on you doing it? I said, then my largest investor should get the hell out of my stock. I don't want you. I'm going to invest in the business, and I'm going to grow it. They got out at $39 and got back into the 109. And when they got back into the 109, they said, whoops, we made a mistake. Yeah, you did. So when people complain about what my shareholders want, you can change your shareholders.
So the man's not going to be bullied by anybody. They said, no, you're going to pay out more of a dividend. No, I'm not. I'm going to run this company how I'm going to run it, and I'm going to make it successful.
You just have to be honest with them.
So what do people in healthcare, health insurance industry, what do they miss right now that you think they would be wise to pay attention to about where this is all headed? What do you think is just generally undervalued or overlooked in the industry?
You ready?
Because the industry has such a small margin, right? It's anywhere from 5 to 7%, depending on the product type. We manage thousands of little metrics every day to make sure we hit our medical cost targets. Because when you miss your medical cost targets, your medical loss ratio, the street punishes you endlessly. And we do a lot of stupid things across a large organization, like prior authorizations, that sometimes may seem good over here in medical costs, but are really bad for your customer service. And unless you look at the whole thing and you have to have one anchor point, who's my customer? It's the member. How do we make sure we know we're doing the right things? Whatever we do in the way of investment in the firm needs to enhance the member experience every time we do it, or we have to ask ourselves why we're making the investment. That's what we think here at Oscar. And that's why we have an NPS of 66. And when you don't do that and you have a bunch of people picking at different parts of the P&L trying to make their numbers, quote unquote, you get a miasma that results in bad stuff. Like the shooting of a CEO.
Which I wanted to actually ask you about, because you have a unique vantage point to, I mean, not only a horrific act in the industry, but just the reaction was kind of people in general, and some people,
horrible reaction.
taking their frustration out on maybe how a system has treated them, and what was your perspective on all of that, seeing that and seeing the reaction of sometimes.
Customer service is everything. In any market, you're dealing with people. Any market you're dealing with people, customer service is the biggest part. It's most important. And when all of the health insurances are hated, Oscar's driven by AI, driven by the customer having a great experience and wanting to be part of their business, of their community. Most important. Robinhood created and disrupted the brokerage industry by making things cheaper, more fun, and going after a targeted audience and going after what the customers want. And they continue to do that. They continuously innovate to give the customers what they want. SoFi is doing the same thing. HIMS is doing the same thing. Palantir is doing the same thing. NVIDIA is doing the same thing in different ways. You go after these companies that treat their customers very, very good. And the customers say, I like that.
People supporting, essentially, an act of murder.
I'm not surprised by the anger and the frustration. I'm not. Everybody I know, including me, when I access the system because of my neck injury and everything I had, including me,
skiing accident.
I have stories to tell. And that's why the system is broken. But because we deal with 6,500 hospitals and 760,000 providers and 1,300 insurance companies and X pharma and Y device manufacturers, all with different revenue models and different economic models, like doctors work on a cash basis. Hospitals work on a revenue basis. As long as my revenue grows, I can afford more stuff. Insurance companies, biomedical, pharma, they all work on a margin basis. Throw all those economic models together and you got yourself a mess. There's no alignment. And so what do? You try to either consolidate, which we now see not working. When you see the PBMs at the large insurance companies, you need to really start to focus on who the customer is. And so I think every American should have access to an individual policy where I can buy my network, my product that works for me and my family. But when you work for an employer, they pick something on the average employee. There are no average employees. They pick the coverage, what's covered on the basis of average employees, not for the people who really need good coverage on either end of the spectrum in different ways. And so what we have to do is create an individual market. And that's why I think the ACA market with 24.2 million people and a 3.5% trend for the last 4 years actually is the place to do it. I remember 20 years ago, we said we will reach nirvana in healthcare reform when healthcare cost inflation rises at the rate of CPI. That's what's been happening in the ACA for the last 4 years.
You mean the consumer price index, that just the cost of good, it's increasing at the same rate, not in any particular higher rate, just everything's rising.
3.5% for the last 4 years in the ACA. And the reason is that because when you're developing an individual product, you can do narrow networks. And as long as everybody's in the market with their own narrow networks, I as an individual can buy the network I want, not the one my employer bought for me, which is usually a wide area network, which has less cost advantage to it because everybody's in. instead of people having a narrow network where you get better pricing and you get better premiums.
I see. So you're saying that better to have like a lot of smaller niche specialties, but a lot of them to empower choice than one mammoth thing that sort of is suitable for no one but the average person that doesn't really have a lot of specialized needs.
That's why I think, with ICRA, the individual consumer health reimbursement account, can work for the gig economy, 30 million people, can work for small group and middle market employers. Small group employers have seen double-digit rate increases. Wouldn't they love to have 3.5% in the ACI and build a product that's
ICRA's going to be another growth revenue for Oscar. And either ACA subsidies get extended. Even if they don't, they continue to grow in ACA and they continue to grow in ICRA. In the gig markets, like Uber drivers, anybody who's a self-employed, right? They can easily use Oscar, right? So these are if you get ACA growth and ICRA growth, then this company's going to 100 plus. Not tomorrow, not next year, the next 3, 5, 10 years. Okay. If they get one, they continue to grow ACA and ICRA doesn't really pan out that well.
fine contribution.
Well, then, still massive growth. They could still get to 100 plus. It's just they're going to have to do it. They're going to have to grow a lot, right? And really innovate and really steal a lot of market share.
They give the money to the employees. The employee buys the
$14
product
stock,
they
guys.
want
Come on.
with the network they want. And actually, in most cases, because in small group, most employees are overinsured for the sick people in the group because it's a level premium plan. I can actually have money left over after I buy my policy that works for me. I can use that for deductibles or copays, or I can buy vision, or I can buy dental, or I can buy life insurance. I can do more with my benefits.
Yeah, so I didn't even know this until I started looking into this company and really understanding health insurance at a deeper level. But so when your company, right, when your work that gives you health insurance, when they go and lobby and pay for those health insurance packages, they're having to pay, and you're having to pay more because they're basically just taking the average of the pool of people at your job, right? So if there's a bunch of sick people at your job and you're completely healthy, you're going to have to pay more because the average person in that pool at your work is unhealthy and sick. So if you have a bunch of obese people or a bunch of people with problems at your work, then you're probably paying more for health insurance than, say, um, a bunch of personal trainers that work at, Planet Fitness, and if they get health insurance, well, they probably don't have to pay that much because the group is overall healthy and they don't have to pay that much, right? So what he's saying is with ICRA and gig workers, it's not going to be based off of where you work and having to pay more because other people. You'll pay what you pay because of your health. You're healthy and you don't go to the doctor as much, well, then you pay less. That's how it should be.
And when I buy at that level, the employer has a more stable defined contribution amount over time because they're not paying the same rate for everybody.
All of this, and there's been many plans over the years. It sort of sounds good, but lots of other factors get in the way.
Mhm.
Notably, one, it gets caught in political dynamics. And what do you think about, and what is your perspective on? Because I mean, there's a lot of course, ACA was from President Obama. President Trump kept it. He said it was imperfect. He doesn't like it, but begrudgingly, it's there.
He passed ICRA though. Donald Trump passed ICRA. So think about this. The Dems, when they did the ACA, wanted to make everybody buy healthcare from the government on an individual basis. That was the long-term plan. Let's put the insurance companies out of business. Let's create a strike price, an MLR, minimum MLR, so they can't make too much money sooner or later. They're all going to go away. And when they didn't all go away in 2014 and 2015, because they'd figure out how to be in that market, everybody went, okay, it didn't work. Then along comes Donald Trump. And Donald Trump says, I don't like this product, but I want a competitive market with accessibility and more access and more choice. I want people to have choice. So he creates ICRA. 63% of all the people in the ACA today come from red states. It's his constituency. So when you look at that dynamic, you have to say he can't kill it with 24 million people in it. He has to make it better. But wouldn't it be genius if the Democrats and the Republicans said, let's create an individual market for every American? That's what the Democrats wanted in the beginning. That's what we can do with a competitive product in the ACA today. Let's move forward. That's the story I have for them. Let's do this. This is the moment where we can actually get both parties agreeing to do something that will work for every American.
And how much of your effort has to be because the federal government is
And Oscar keeps lobbying for this up to Congress. They keep lobbying for this exact scenario, right? And what he just said right there, 67% of the people in ACA are Republicans. And like I said earlier, if you kill ACA, if you take away all these ACA subsidies, if you don't renew them before the end of 2025, you're going to tick off a lot of Republicans. And a lot of them might not vote the same way during the midterm elections. And then you lose a lot of seats. You lose a lot of red seats, and those become blue seats. So now you see, and I'm telling you right now, if ACA or what they're trying to lobby for, a fair and clean market, if any of that happens, Oscar will go to 20 plus like that from 14 where it's at, maybe 30 plus in a very, very quick amount of time. Weeks, days, very, very fast. So you have to understand everything that goes into this. You have to understand everything. You got to understand the risks, obviously. You also have to understand all of the opportunities. There's a lot of not being an Oscar. I would argue that not being invested, even at 1% of your portfolio in Oscar Health right now, you are missing out on more opportunity. And basically, you're paying an opportunity cost way more than you would be risking yourself. Okay. I showed you the fundamentals. It's already undervalued. It's already like priced in for worst case scenario. Opportunity cost, you're missing out on it. I'm telling you that right now. You can believe me, you cannot believe me. You are in charge of your own finances, but I know what I'm doing. You do what you feel is best for you, friends.
your big and sole customer that you have to be engaged. You have to make sure, because there is risk, there is existential risk to your business if there was a dramatic change in what the federal government does. How keyed in are you?
I mean, so when the ACA was passed, Ron Williams handed me the keys to the company and said, okay, you're running it now, get ready. And so I had 1,900 people sitting in a room implementing 12,650 pages of regulations to be in the ACA. In another room, I had 300 people. I said, find me the pony in this horse shit. There's got to be a pony. And we did. And so the idea is never waste a crisis. Find the way through. Don't fight today's fight. Look at the longer run and say, how can we win that game? And so I tell our employees here, Oscar is a pirate ship filled with cannons among Spanish galleons filled with gold. All we have to do is take their business from them. Let's take middle market and small group, 6% margins, away from them with ICRA. Let's go after Medicare Advantage by empowering health systems to be in the Medicare Advantage business at 4% margins versus 7% in the insurance industry. And let's change it for all Americans. Let's get people that are in the 100 to 139% of Medicare with subsidies into the ACA, where they have more choice of a product and a better network.
Oh my gosh, guys. How do you not listen to this man talk and understand what he's such a high level thinker? Again, you don't become co-CEO at Bridgewater. You don't become CEO of Aetna without being a very intelligent person, without knowing your craft. And this man knows his craft. He knows health insurance. He knows how to underpromise, overdeliver. He knows the stock market and how it ticks and what they want and what they want to see. Also, this man bought like $400 million, I believe it was, of Oscar at like $15, $16 range as well last year. So he's betting on himself as well. He's got skin in the game, guys. He also gets a lot more money, which he said he doesn't need, right? But it does. It's a driver. Like I said, he wants to help drive change. And I love what he just said. They are a pirate ship filled with cannons, and they're going around to eat and pillage other ships, other broken down dinosaur ships. They got the new innovative ship, they got the destroyers, and United Health and all these other companies, they got the paddle boats. They got the dinged up, rickety old thing, rickety old boats. And they're coming in and just we provide better customer service. Our products are better. Our products are cheaper. We have a better UI, better customer experience. We care about the customer, legitimately care about the customer. You're going to continue to eat up that share with ICRA and ACA. And what did he just say? He said, okay, ACA subsidies go away. Well, guess what? In ACA market, they have more opportunities anyways, and they can keep on taking market share there as well. And if they lose ACA subsidies, yeah, sure, maybe some of them become uninsured, but a lot of people are going to stay insured, and they're just going to move over to the normal ACA markets, not the subsidies. I just don't know how you can not listen to this man talk. And I understand you shouldn't just listen to anybody talk, and me included, and just say, I'm going to go invest all my money into this company because Mark Bertolini said this or because RonnieV said that. I'm not saying that. Just saying, look at the fundamentals, look at the risks, but look at the opportunity. And then sit here and say, look at this man and his pedigree. Look at this man and what he's done in his 69 years on this planet. And sit there and say, well, he's talked about not lying. He's talked about not being that type of person because it's going to catch up to you eventually. He's shown himself to be a good man and good character. He's said and proven that he wants to really change and help people and help change the health industry for the better. Listen to what he's saying and the path that he wants for this company at $3.7 billion, $14 stock. Oh my goodness. My goodness.
Let's make it better for everybody.
Make it better for
And
everybody.
let's put it behind us and say we don't have to deal with that crap anymore.
And what is your advice for any other CEOs or leaders on just dealing with entrenched industries that are built a certain way over time that are very hard to
If you ever watch Water Against Stone, eventually it
We can
depends
skip
on
through
which
this a little
opportunity
bit.
in a way for the betterment with what's going on. Medicare Advantage for profits, middle market employers are lost in the middle. They're the only group left of insured population, of truly insured group population, is the middle market and small group, 50 to 1,000. And so as you look at all that, all these people are unhappy with rate increases or what the government wants to do to regulate them. Let's stop all the madness and create an individual market where we separate the investment from the financing decision. So being from Detroit, if I walked into a dealership and I said, I have $350 a month for a car, guess what would happen? I get a lousy car. I get a bad deal. But if I say instead, I want this kind of car, I want 4 doors, I want it to be able to travel this far, whatever it may be. And then you say, how much does that cost? Then let's finance it as cheaply as possible. That's the way health insurance should work. Let's understand what we need to do for people, what product they want. Let's find the cheapest way to finance it. Instead of the other way around, we hand them a warranty card. Here's your ID card. When you get broken, you go get it fixed. Go to one of these providers. We've got the investment and the financing decision conflated in healthcare, and it just doesn't work. So if you turn to people who buy the healthcare, turn to the people who are angry at the healthcare industry and say to them, what do you want? Let us offer the opportunities for you to pick. You choose. Your employer or the government will give you the subsidy
really should
to go
be.
do it. The choice is mine. I remember Brian Monahan at Bank of America. They were the last people to do online check deposits. I said, "Oh, why did it take you guys so long?" Says Mark, we were afraid of people making mistakes and blaming it on us. And what we found out after we tried it is when they made mistakes, they blame themselves. They owned it. So let's let Americans own their healthcare. That's and so in any industry, you have to look for that opportunity that says, where are the opposing parties? But this is what I'm telling a lot of my friends now, my CEO friends now, is stop reacting to everything the Trump administration does today. That's noise. Look at where it's all headed and fight the fight where you need to fight it, but not every inch. You'll exhaust yourself. You'll get confused. Flight, fight, or freeze is what happens when your anxiety is high enough. Don't let that happen to you. Look ahead. And so I think, a lot of people haven't looked far enough ahead. And quite frankly, with CEO average tenure about 3 to 4 years, nobody wants to. I had a friend who left as a CEO after 4 years and said, the only thing I can say is I'm glad I didn't screw it up while I was in charge. It's like, wow, what a legacy.
And final question for you is, what is your perspective on just someone?
That's crazy. You can just tell, the type of person he is just by what he just said. His friend came to him and he's like, "Oh, I was CEO for 3 years, 4 years. I'm just glad I didn't mess it up." Oh wow, what a legacy! Legacy, be something, do something great. That's what he's trying to do. That's why he came to Oscar. Trying to do something great here.
You describe it yourself as you were retired. You weren't playing. You're reducing your board activity, focusing on. I know kind of like dogs is one of your.
If you're still here in this video, you're getting the most alpha. You're getting the most alpha out there for Oscar right now. You are. And you're a beast. If you're still here in this video, you're an absolute beast. I know it's a long video. I know. The video is 40-some minutes, and I'm giving my own takes on it. I'm giving my own bull thesis. We went over the high five snapshot. If you're still here and you're not subscribed yet, hit that subscribe button. You're clearly here for a reason still. Hit the like button. Also, you're just a beast, and you really care, and you're really going to be a great investor one day, if you're not already. You really are. Because if you're going to put this much time and dedication into watching this, and really trying to understand companies at a high level by doing this, you're going to be very successful in your investing career. I promise you that, friend.
Your passions as well. What is your perspective of just the balance between sort of experience, wisdom, know-how? I'm sure you're in a ton of meetings too with young up and comers who think they know everything. Maybe they've been very successful in some right. Maybe they don't. The experience is not typically one of the things valued as well. What is your advice for just balancing all of that, making companies perform well, and for people on either side? You're the young up and comer, get great outcomes.
There are two things I look for in every executive that I evaluate.
We can kind of skip through this, guys.
And so people,
if you want to watch it, I'll put the video down below.
You ever got in your career and on this journey? What
use his name? I said, no, I would never hire you.
What was the bad advice? What was the worst advice you ever got in your career and on this journey? What was the negative role model?
My dad told me your memory is too short to lie. Always tell the truth, whether it hurts or not. Your memory's too short, and somebody's going to catch you one time, and it's going to be so embarrassing. It's going to cost you all your credibility. So people know that when I say I'm going to do something, I do it.
Come on, guys. Come on. How can you listen to this man and sit here and not take him at his word? How can you sit here and not take this man at his word? He's been in business. He's been CEO. He's been co-CEO. He's been with all these companies. He's still here. He's still around. He didn't get there by lying, cheating, stealing, being a terrible scumbag person. Come on. This man's ethics, morals are top tier. Seems like an amazing guy. Seems like an amazing person.
They know when I believe something, I'm believing it. And if I knock on wood, nobody's ever called me out for my integrity. I tell people this: of all the things you have, your home, your family, your possessions, your intelligence, all of that, can be taken away from you. It can all be taken away. There's only one thing.
First thing I learned while I was in the Air Force, integrity first. It is very important, very crucial, and you should always have it. One of the first things I learned when I was in the Air Force.
You have to give up. That can't be taken from you. Only you can do that, and it's your integrity. Only you give that away. It's a major fatal flaw. For me, I catch somebody in lies. It's like, I'm done with you. There's no reason to do that.
Well, Mark Bertolini, I could talk to you all day. Fascinating guy. Insights on healthcare industry, healthcare insurance, but also.
Wow, guys. What an absolutely amazing interview. What an absolutely amazing interview. What didn't we learn? What didn't he touch on about Oscar, this company, where they're going? After watching that, I'm even more excited as a shareholder. Even more excited as a shareholder, and I'm even more driven, and I'm more passionate about the CEO. I really like Mark Bertolini. I really like this man. I think he has good ethics. I think he's a man of God, and I just think he's a great CEO for this company. And I think he's going to bring and take Oscar to the forefront in the healthcare industry and eat up market share. And I really think he's going to, the type of morals that this man has really like kind of gives me Alex Karp vibes, right? Wanting to do the right thing and wanting to do. I can see this man wanting to do good because he wants to do good for his employees and pay them first with the share going up, the share price going up. And I feel that he wants to do the same thing for shareholders. Bring them along with us. I'm sure this man loves the Oscar shareholders, similar like Alex Karp. Yeah, what an absolutely amazing interview. I'm going to pin the full video down below to give Branded a big shout out. Go give Branded a like and follow and subscribe, because that was an amazing interview. And I think he does other interviews like this. He's a small account just like me. So help us out, help us grow, help us get our voices out there, help us help other people in their financial journeys, or just him interviewing CEOs and just seeing how they tick and seeing who they are deep down as a person. I am very impressed by Mark Bertolini. I think he's a top tier human being, a stand up person, and there's no one else right now that I would rather have at the helm of Oscar Health as a shareholder myself. And I'm very excited about Oscar, as you already know. I'm very excited about where this company is going to go in the future. And yeah, guys, that's going to wrap up this video. It was a beast of a video. If you're still here, thank you. Also, give yourself a pat on the back, guys. You truly want to learn, you truly want to become a better investor, and you truly are willing to put in the time and effort it takes to become a better investor by watching interviews, by listening to conference calls, right? This is where all that alpha is created. This is where I get a lot of my content ideas when I post on X or when I make a video. This is where I get my thesis, my bull thesis, my base case thesis, my bear thesis. This is where I get those things. It's not just by punching numbers into an Excel sheet. It's seeing if it's undervalued, then going and deep diving into the fundamentals, diving into the 10Qs, the 10Ks, diving into interviews, listening to earnings calls, listening to, like, that man is calm as a cucumber when he's talking about all of this. This man knows what he's doing. And he's going to take Oscar to new heights and back to all-time highs. I truly believe that. No investments 100%. None of this is financial advice. Run your own books. I'll run my own books. And if you're a hater, go be a hater. I don't care. Talk to me in a couple years from now, and we'll look back on this and see where we are. Time is the ultimate gauge for investing. It's the ultimate gauge. If Oscar runs the 50 tomorrow, it doesn't mean anything, because I'm looking at where they're going over the next 1, 3, 5, 10 years, not what they're doing tomorrow. And price action doesn't mean where the company's going. Okay. So I appreciate you guys all being here. Like, subscribe. Go give Brandon a like and subscribe as well. Appreciate you guys all. Hope you have an amazing rest of your weekend. I love you all. I love this Oscar shareholder community. It's growing every day. It's becoming bigger and badder. There's so many great minds in the Oscar shareholder community, and I can't wait till we have that official Oscar party when Oscar goes on its massive run over the next 3, 5, 10 years. We'll all have to link up and meet up somewhere and have a big Oscar party to celebrate, right? So I appreciate you all. Hope you have an amazing rest of your weekend, guys. And I'll catch you in the next one. Take it easy.